Hey everyone, my name is Ian. I am a dividend stock investor, meaning I invest for cash flow that I earn in my sleep that I can use to pay my bills. I want to do a special video today where I illustrate how I would hypothetically invest $10,000 for the new year, for 2021 and beyond, if I were starting all over again. I've been in the game for a long time, kind of like E40 and Too Short. I just watched their rap battle this week, and one of the pieces of wisdom that came out of the rap battle is that both of them pay respect to the OGs. They pay respect to the older generations, and they sit down and they listen what the older generations have to share with them. That's how I am. A lot of people say, Ian, why do you invest like an 80-year-old? Oftentimes I do invest like an 80-year-old because the 80-year-olds out there know a lot more about life and about investing than I do. But I like to think of my strategy as threefold. I have that portion of my portfolio that is inspired by the elders, by the 80-year-old generation. I have the portion of my portfolio that is inspired by myself, by the present, by a thug life dividend investor, which is what I am. And then I have a portion of my portfolio that is inspired by the future. It is inspired by the younger generations. The purpose of the video today is I want to include a well-rounded dividend stock portfolio that is inspired by the past, the present, and the future that will perform well in 2021 and beyond. And in particular, the video today is targeted more towards those that have some time on their sides. I would say it's those types of investors right now that are 35 years and younger. I'm kind of looking at myself historically. When I was younger, when I started out, I've been in the game for over 20 years, but if I were younger, I were just starting out, this is the type of dividend stock portfolio I would think about. But don't worry, if you're over 35 years like I am, this video is still really relevant because it's important, as I just illustrated, to look at the past, present, and future. Even for someone that's older, inspiration can be drawn from a portfolio that's more geared towards someone younger, someone that has more time on their hands. And so, quite frankly, I just opened a new stock position today. I bought a new stock. This is position 48. I now own 48 dividend stocks in my portfolio. I bought a company called UTZ. This is ticker symbol UTZ. This is a fast-growing snack food company, but they've been around forever. I'm going to talk about them in the video today. This is a small position in my portfolio, but it was really inspired by the video today, if you will. It was inspired by the fact that I'm hypothetically constructing a $10,000 portfolio for my younger self. How would have I done it? Look, even though I'm older, I still draw inspiration from the future. I still draw inspiration because, quite frankly, the portfolio I'm building is not only for myself, it's multi-generational. It's for myself and my wife to enjoy during our lifetimes, but I'm building up generational wealth that my kids can enjoy as well. And so I'm looking past my lifetime. I'm looking lifetimes into the future. Get ready, everyone. This is how I would hypothetically invest $10,000 for Ian of yesteryear, looking at 2021 and beyond. All right, everyone, I am back in the studio and I dressed up because this is serious business right here. Check it out on the screen right now. What you see in front of you are 10 positions that comprise this hypothetical $10,000 portfolio for 2021 and belong. Keep in mind what you see in front of you right now is very different than the types of sample portfolios I have shared before. I will link in the description to my last video that I did on hypothetical portfolios for investing $10,000 that are more traditional and more aligned with where I'm at in my personal life stages. But what you see here is a portfolio that is poised for total returns and dividend growth for a younger hypothetical investor that has a lot of time on their side. And so the first position that you see in front of you right now is Johnson & Johnson. I always have to start with Johnson & Johnson. It's my number one favorite dividend stock of all time. Out of all of the stocks listed here, it is perhaps the only one that is on sale or at a reasonable value, if you will. I look at J&J as a mutual fund of sorts of the entire healthcare industry. You've got pharma in there, you've got medical devices, you have consumer products related to health care. It is just such a fabulous company that has a wonderful balance sheet with low amounts of debt and solid returns over the long run. I love that this stock carries a reasonable dividend growth rate. You can see here I actually had to split this into two different rows. And so at the top, you see the first few metrics for each position. And in the bottom table, it continues the same 10 positions. And you see that the dividend yield on Johnson & Johnson in that second table is a 2.65% starting yield, but it has a respectable payout ratio of 50% and a 5-year dividend compound annual growth rate of 6.1%. So they raise the dividend on average per year by 6.1%. I'm not going to fool myself here or anyone out there. Starting a $10,000 dividend stock portfolio right now as we head into 2021 is a tricky time because the share prices are so high, the PE ratios are so high, starting yields are low. That being said, in my humble opinion, there is no better time to start with dividend stock investing than the present moment because dividend stock investing is not one and done. It is a process. It involves slowly deploying money over time and building upon one's portfolio. It is a long-term thing. And I tend to believe that time in the stock market combined with dollar cost averaging is much more important than timing the stock market. So let's keep going. Check it out on the screen right now. The second position for this hypothetical portfolio is Apple. And so Apple, there are rumors headed around right now that they will be producing this electric vehicle. I cannot wait. That is super cool. But putting that aside, this is just such a incredible company. The iPhone has become so critical to all of our lives, and the services division of this company is growing very quickly. I think Apple over the last few years, and especially during the pandemic, has proven that, hey, yeah, it is very heavily weighted on the iPhone, but that just doesn't matter. And we will see over time as this company branches into more products, but I surely think that their UI design and that their product design is second to none. And so as you can see on the screen right now, Apple is trading at a lofty price earnings ratio. You can actually see that on the bottom table again, that for the current year, the PE is a 33, 30 for next year, and the starting dividend yield is a really low 0.62%. However, there's a lot of room to grow that dividend because the payout ratio is only 20%. They're only paying out approximately 20% of their earnings as dividends. And the 9-year or the 5-year compound annual growth rate for Apple is a staggering 9.5%. And so again, this hypothetical scenario, it's not for someone that needs cash flow to pay the bills right now. It's for someone who needs the cash flow to pay the bills in 20 years, 30 years, maybe 40 years from now. And for someone that has that much time on their side, starting yields aren't as important as the dividend growth. And starting yields aren't as important as investing in solid companies that have strong balance sheets, that have strong prospects for future growth, that can continue to grow the dividend at very high and rapid pace. So let's keep going. Check it out on the screen right now. The third stock on this list is Church & Dwight. I will link in the description below. I recently reviewed this one. No, I do not own this one. I actually list in the first table at the top. You can see, do I own it? I have a yes for J&J and Apple and a no for Church & Dwight. This is a consumer packaged goods company, and so the first one's healthcare, second one's tech. You can see here, because there are only 10 positions, I am trying to have representation across all of the major industries, or a lot of the major industries. This one is consumer packaged good basics, and so Church & Dwight makes household products that we all use and enjoy. Some of those examples just include their iconic baking soda, but they also make the Trojan brand of products, and also they own Waterpik and a bunch of other different CPG basics. Now, I have a column here in the first table called alternatives. You can see Clorox Company, which I do own, is an alternative to Church & Dwight. The reason I selected Church & Dwight here, however, is because it is a smaller company. You can see in the first table all the way at the right, I list the market capitalization. This company is only a $21 billion company, and the dividend yield for Church & Dwight, the starting dividend yield, it is very low. It is 1.11%. Although I generally believe that the upside prospects for Church & Dwight are better than Clorox over extended periods of time. Now, for me, given where I'm at in my personal dividend stock investing career, I'm happier with Clorox for myself. But again, I'm trying to present something different here, a different viewpoint, a viewpoint for someone with a longer time horizon than even myself. And I would say Church & Dwight, in that particular scenario for a CPG basics, would probably be a better fit than Clorox, but I do list Clorox here as an alternative. Let's keep going. What you see next is the fourth position. This is Starbucks. I put a resounding yes with 3 exclamation points next to it because I love Starbucks. I am there all the time. I was there today, and I bought Starbucks, not even talking about my reinvested dividends. Net new capital deployed 30 times this year. And this is in the restaurants industry. The reason that I include Starbucks here is a hyper growth company. This is a company that has increased its dividend by 17.6% on average per year over the last 5 years, as you can see all the way in the right-hand side of the second table below. And they just announced in their investor day that they're going to be opening all these new restaurants, and they will just keep on growing because the company is doing well, and consumers are realizing that throughout the pandemic, it is a necessity to enjoy Starbucks. And I think some of this, quite frankly, goes back to the generational conversation that is embedded in today's video. I have some of that in the introduction. I'll have even more of it in a clip later in the video today. But when I look at younger generations, there is the simple luxury of a Starbucks experience that no matter how hard times get, that experience will not be foregone. And I do not blame them one bit because I am right there with everyone else that I do enjoy my Starbucks. Although I have cut back a bit this year to save money, to enjoy more capital deployed in dividend stocks. Let's keep going right now. And so the next one on the list, number 5, is McDonald's. This one actually, you could say there's some overlap with Starbucks, and that is true. They are both restaurants, but I actually list McDonald's here as the real estate play. And I would not be surprised at some time over the next 10, 20, 30 years, this becomes 2 companies, a real estate focused company and a restaurant company. They might break out the real estate as a separate company, a real estate investment trust. We shall see, but maybe they won't. Whatever they do, I love buying this company for real estate, although they are also a restaurant. And you could also argue they are a tech company because they purchased all these tech companies. They have a Silicon Valley office and they are doing dynamic menus and ordering and predictive modeling, AI, if you will, for customers. And so McDonald's is in a little bit of everything. I bought this company earlier this year heavily when the stocks tanked in March and April. I'm glad I did because it has rebounded quite a bit. And so with McDonald's, though, I can't imagine a dividend stock portfolio without a healthcare company. There's only one that I could consider iconic, and that would be J&J. There is no dividend stock portfolio that I could consider without a real estate company, and there is no better real estate company than McDonald's in my opinion. Anyways, they have raised the dividend by 7.7% on average for the last 5 years. You will note that the payout ratio is a lofty 83%, and so most of the companies in the list today have very low payout ratios, and they have a lot of room to grow the dividend. McDonald's, by contrast, is one of the ones in the list with a higher payout ratio, and so the dividend growth in future years may be smaller than it has been, although we shall see what happens over long periods of time, because if their growth ramps up yet again, dividend growth will also. Let's keep going. And so what's next on the list? Southern Company. And so one of the things I want to really embed in this portfolio is respect for the OGs, respect for the old-time investors, the thug life investors like myself. And so there's nothing more OG when it comes to the world of dividend investing than utilities, regulated electric utilities. And Southern Company is one of my favorites. I list Duke as an alternative. I own that as well. And so Southern Company, there's not going to be huge capital appreciation, but it is trading at a reasonable value right now. It is trading at a PE this year, current year PE of 18.7, next year 17.99, not bargain basement. probably a little overvalued, quite frankly, but in the world of everything out there right now, hey, reasonable value compared to a lot of these. What I do like is the dividend yield. That is a starting dividend yield of 4.29%. Yes, the payout ratio is high. That's expected with a regulated electric utility. They can afford to pay out because it's not a growth company. And the dividend is growing slowly at 3.3% over the last 5 years on average. But the reason I include Southern Company in this portfolio is it's an OG stock. And for a younger investor, an investor with more years on the horizon who is just getting started in dividend stocks and is going out with the first $10,000 to build a portfolio, that investor will evolve over time. And one day that investor will be my age. One year that investor will be a lot older than me. And I think it's important for all of us to think across the generations. And I think it's important for all of us to recognize as dividend investors, we will change over time. We will adapt because our needs will adapt. And Southern Company is the type of dividend stock that makes a lot of sense for someone that's headed into retirement right now, financial independence right now. Even in early financial independence, of financial freedom, retire early, Southern Company is a perfect stock that offers a ton of current yield. And I think it's good to have that in the portfolio here, just to remind the younger investor, the investor with more years on their hands, that, hey, one day it's not going to be about working and investing. One day the portfolio will pay for everything. And Southern Company, I think, is a reminder of that, and a much needed reminder and a way of paying respect to the olden days and the old time investors. Let's keep going. And so next one on the list, by the way, I own all of these so far except Church and Dwight. Let's look at the next one, Walmart. I think it's important to have retail in there. Home Depot was a really close alternative. I own that one as well, but I ultimately selected Walmart here because when we look at long periods of time, I would not be surprised with their hybrid brick and mortar and online strategy that Walmart can compete really aggressively with Amazon. And I love Walmart for that because I would love to see Walmart thrive. Walmart's market cap is huge at $408 billion, but it's quite a bit smaller than Amazon. And so there's a lot of room there. Yes, the PE ratio at a 25 is pretty lofty, but there is huge growth opportunity there. And yes, Walmart does not increase the dividend very aggressively. In fact, maybe Home Depot would have been better suited to include here as a dividend growth company because I know Home Depot is growing their dividend quicker than 2% on average, but Walmart's payout ratio is 38.7%. I think in recent years, they have not been growing the dividend quickly. And part of that is they are innovating and reinvesting in their company. And I think that's important because, again, the investor here doesn't need the cash flow overnight. The investor here needs massive cash flow that can pay bills 20 plus years from now. And so when I just think from a pandemic state of mind and from a holistic state of mind, when I think of having a weight and importance of technology, you'll see a recurring theme here. Obviously, Apple is a pure play tech company, but did you know, obviously J&J is a tech company, but just in the healthcare space. Starbucks is a tech company. For the longest time there, they had the number one payment processor around, and their app, their mobile app, still is one of the apps that processes the most payments out there. McDonald's is a tech company in many ways, and I would say Walmart, at least at this time, is much more of a tech company than the Home Depot. And so you can see I have a tech focus with this particular dividend portfolio, even though it is a dividend portfolio, not a tech portfolio. So let's keep going. And so the next stock on here is shout out to my man Sam. This is one that Sam brought to me. I love this company. It is called RPM International. I use this one to gain exposure to, say, the industrial space in here. And this company, it's kind of building products. It's caulkings, adhesives, if you will. And I would say alternatives to this, great alternatives to this could be 3M Company, which I own, or WD-40 Company, which I do not own, but I have reviewed here before. The reason I included RPM, again, is this portfolio is geared for long-term growth, and just having a market cap of $11 billion, having a dividend compound annual growth rate of 6.7 per average per year, with a payout ratio of 37%, I would say RPM International has more of a growth profile, if you will, than 3M. Now, WD-40 Company has a similar growth profile to RPM, but WD-40 Company has shot through the roof in terms of share price. So in good conscience here, I could not include WD-40 on the list here. It is just too expensive in my humble opinion. And that is saying a lot because most of the companies on here are priced to perfection. But I'm willing to overlook that given the amount of time that exists for this hypothetical scenario. And so that's RPM. Thanks, Sam. Shout out, buddy. I can't wait till we can have those meetups again after the pandemic and talk stocks again. Sam is one of the OG investors here in the community. Check it out on the screen right now. Let's talk about the next one. You guys will be a little surprised here, but I love CPG food. I talked about CPG basics, consumer packaged goods. Food and snacks are really important, and there are a lot of choices here. I own a lot of these types of stocks, such as PepsiCo, for example, is my number 2 favorite stock of all time. I did not include PepsiCo on this list because it's just growing too slowly. I'm sorry. For an investor at this profile, doesn't make as much sense. For an investor of my profile, makes all the sense of the world, and I love Pepsi, but I wanted to go for growth here. And so this particular stock, Utz brand, is a stock I bought today. It's position 48. I now own 48 stocks in my portfolio. Perhaps I'll go into more of a deep dive of this one in another video, but we only have so much time today. This is a brand that basically makes salty snacks, potato chips, pretzels, cheese balls, other salty snacks. It has a huge presence on the East Coast in the greater Pennsylvania area, and also has a huge presence in the Pacific Northwest. The reason so is they acquired the Tim's brand of chips, which makes actually those Hawaiian-style potato chips that I love so much. And so I like to invest in brands that I use, brands that I understand, that I use all the time. So we shop at Walmart, we shop at the Home Depot, we enjoy our Starbucks. Everything on here pretty much we have consumed in one way or another. I'm talking about myself, my wife, our family. And so anyway, new one on the list today. And I'll tell you, this one will make a little bit more sense to you in a second when I talk about Bitcoin. We won't go there just yet. But I like to have in my portfolio a little bit of a speculative position. And I wouldn't say this one is super speculative, but when you look on the screen right now, you will probably think so because the price earnings ratio is a 57 this year, a 40 next year. Although the price earnings ratio for UT's or Utz brands, I would say, is a little misleading because they have been growing through acquisition and there's a lot of depreciation that's just throwing off GAAP earnings. And so when you look higher up in the funnel in terms of earnings, the metrics make more sense. This is a company that only went public this year. And this company though, by the way, Utz brand's been around since forever, basically. Long, old school company. And they are in the snack food space, and my understanding for salty foods, I think they're only behind Pepsi, which is number 1, which I own. Campbell's Soup, which is a stock I own as well. They're number 3 behind Campbell's Soup, and I think it was 3 or 4. They're somewhere in that matrix, in that ranking, and they're obviously behind Pepsi, which owns Frito-Lay and Campbell's Soup. But they're an up-and-comer, and they are basically growing through acquisition. They recently acquired On the Border tortilla chips, which is a super brand. And I think that's the number 3 brand of tortilla chips, by the way. And so I have a lot of love for this category. It's a category I understand. It's a category that I live and breathe every day. I'm big into snack foods. I go running a lot, so I enjoy the salty snacks, by the way. And anyways, I didn't go crazy on this. I put in a small amount. It's not going to be a big position for me. But the reason, quite frankly, I bought it is to pay respect to the very video I'm doing now. I bought it to pay respect to the younger Ian. I bought it to pay respect to the fact that, honestly, I'll talk about this in a segment later in the video today, but I'm kind of in this wedge generation where, knowing what I know now, I would have started and gone even more aggressively in my earlier years. and I realized that some of my life goals, which are honestly quite lofty, they may not be fully realized until the next generation. And so that's kind of how I'm looking at Utz brand is honestly, I may not see the full benefit of this thing in my lifetime, and I'm taking a small sliver of a position, but at the same time, I'm starting to look multi-generationally. I'm starting to see my dreams become realized, a lot of them in my lifetime, but more of them after my lifetime. And that's kind of how I'm looking at Utz brand for myself personally. But I put it in here because I think it's a really unique stock for the younger investor. Now, I'll tell you, shout out homie, J Mac Investing YouTube channel. Check him out, J Mac. He is an expert on SPACs, or special purpose acquisition companies. Now, I did not realize, but Utz brand became a publicly traded entity this year through a SPAC. And that's something new that I learned today from my friend J-Mac. I didn't realize. I thought, hey, they probably just went through the traditional IPO or initial public offering protocol, but they did not. It was actually through a SPAC. And so I don't want to go into it too much depth today because we only have so much time. But if you want to learn about SPACs, go over to my homie's channel. I will link in the pinned comment below, JMac Investing, to learn all about SPACs. But this, to my knowledge, is the first SPAC that I own out of all of my 48 dividend paying stocks. And they do pay a dividend already, of course. I really, they pay a small dividend, but I probably can't buy a company that doesn't pay a dividend. Not in my DNA. Let's keep going. Actually, after just saying that, it brings me to my last one. But I would say this is not a company as much as it is a currency. And so I list Bitcoin on here. I think I'm going to get into some trouble today for mentioning this. But as you can see on the screen, I have a 10% allocation to it, or $1,000. But I was thinking, hey, you could probably put in $500 instead and then put the 500 savings into J&J. That's probably a little bit more prudent than putting 10% of a portfolio into this thing. But I'll tell you, I'm trying to get exposure to all the industries, and I'm trying to look from a forward-looking standpoint. And Bitcoin, in my opinion, embodies what's in the future for the financial industry. And so this is a new currency. It is a network. It is the protocol. It is the backbone of the financial system of the future. And so for myself, you may remember I did some videos on Bitcoin a long time ago. Please put a shout out in the comments below if you remember those videos. I earned a really solid profit, and I harvested that profit and I reinvested it actually into a real estate venture, which ended up becoming the self-storage facility that I'm a part owner in. Now, the Bitcoin, though, of today, I must say, you can see on the screen right now, yes, I own it. I talked about this on my Patreon recently. I've been buying it last few years. After it bottomed out, I started dollar cost averaging in again. I've bought a lot of it in the 4,000s, basically between 4,000 and 10,000, 12,000, kind of that range I was going. These days, I'm not buying more Bitcoin. And my Bitcoin position is very small. But the way I look at Bitcoin is at a certain point, I will harvest those gains and redeploy it into dividend stocks. And so that's how I would look at it for this hypothetical portfolio as well. It's a good place, in my opinion, to park cash. In an environment that has a lot of dollars being printed, there is a lot of sense, in my opinion, of having some of one's cash position in Bitcoin. And I like this notion of getting off zero. The idea is, rather than having a 0% allocation, have some allocation to Bitcoin. And that's kind of how I look at it. Now, again, I'm not adding to it here. But for this hypothetical portfolio, just starting over, again, hypothetically, 10,000, I would say of that 10,000, if I had a lot of years on my hands at current prices, I would consider putting $500 or maybe $1,000 into Bitcoin. But again, understanding it is a speculative position. Now, one of the things about Bitcoin here is you probably won't find me talking about it again after this video. Now, I did a shout out to my patrons, and if you want some exclusive bonus videos, I'll link to it in the description, the pinned comment below. I have a Patreon. You can unlock all the videos right away. Thank you to my patrons. if you want to learn more about some of my Bitcoin moves, you could check out the recent Patreon video. But the reason I don't want to talk about it here on YouTube too much is, look, I'm a dividend guy, and I think it's a responsibility of mine to kind of keep it real to dividend stocks. And so I just don't want to talk about it too much on YouTube, but I do own it and it has performed well for me. I'm going to continue to hold it, but I don't look at it as buy and hold forever the way I look at everything else. I look at it as a means to harvest gains that can be used to deploy into dividend stocks. And because I'm not buying Bitcoin anymore here, it's run up so much. That's one of the reasons I got into UTZ brand, quite frankly, is I kind of look at it as my little kind of speculative pet project that I'm accumulating now, just a little bit at a time, just for fun. And so that's why I bought that one today. One of the reasons, at least. And so there you have it. That's that. What do you think about this hypothetical portfolio? Please share in the comments below what you think. Please give me a like if you enjoyed the video today so far. I've got a lot more to go, so don't leave yet. But please give me a like. It means the world to me. I would love to see if we can get over 1,500 likes on this video, maybe even 2,000. I am reaching for the stars. I love you all. I'm putting a lot of work into these videos, so all the support means the world to me. I want to now move to the next section where I just give a summary. What am I doing here? So check it out on the screen right now. How am I constructing this portfolio? So some of this is review, and I'm going to go quickly to optimize your time, but it's really a key realization that this is for a long-term investment horizon. And I realize the entry PEs are high, but I also realize that time in market is important than the entry more important than the entry price in this lofty stock market right now. There's no better time than the present to get started with dividend stock investing, in my humble opinion, for anyone with a longer time horizon. The market is very expensive, so I do think expectations of any investment right now should be realistic. Dollar cost averaging is the way I would deploy, and so would I take $1,000 across each of these 10 assets and deploy it overnight? Probably not. Given that commissions are free these days in the United States, I would slowly dollar cost average in over time to mitigate risk, and I'd probably hope for a correction in 2021 to get some better prices on some of these. Let's keep going. I would place priority on dividend growth versus current yield. You can obviously see that in this portfolio. This is a really forward-looking portfolio. I would automatically reinvest dividends. I would make sure my commissions are zero. And again, this portfolio allocation, it's not for me right now. And it's not for me anytime recently, quite frankly, but a younger PPC Ian would totally look at something like this. And quite frankly, I bold it here. I'm starting to realize that I need to look at things like this and be open to them, because not all of my goals may be hit in my lifetime, may be achieved in my lifetime. And so I need to have some of those long shots, those moon shots that Google calls them. By the way, I know Googlers, any out there watching the video, shout out. I love YouTube. Give me a thumbs up. All my homies there at YouTube and Google. But I know at Google, all the employees are kind of challenged from time to time to think about your moonshot. And this is just something really big, some huge, audacious goal. And, that's how I'm looking at this. So let's keep going. And dividends portfolio includes some OG stocks, especially Southern. I talked about that. I do focus on smaller companies here, and not all of them are small. A lot of them are mega caps, but I do have smaller companies in here to hypercharge growth. I include 10 positions, whereas I would have usually included maybe 5, given the amount of money that's being invested, just because this is a portfolio for a younger person, and a younger person is going to be deploying more money. So starting small in each position, it's kind of spreading things thin. A lot of positions for a portfolio of this size, but I think for someone hypothetically with more years on their side, hey, it makes sense. Let's keep going. So I would say this is a portfolio for a more active dividend investor. Now, surely I wouldn't want to ever say dividend investors are active. Dividend investors are supposed to be passive. That's the whole point why we're investing in dividends, to collect cash flow that pays bills. And this one will not be done in the short run. This will be a yield on cost play over the long, long run. But I would say this is for a more active investor, just because there are positions in here that probably require a little bit more attention. These are more volatile positions. Some of these are more risky positions than my dividend stock portfolio, for example. And while I own most of these positions, they're not in these allocations. My allocations are heavily skewed towards very, very conservative companies. And so before I go next on to the next thing, I want to give one more shout out. I forgot in my last video, and so I'm including more shout outs in this video to all my homies. And I just want to say shout out Instagram, my friend Gregory, the Dividend Monster on Instagram. Check him out. He has a huge dividend portfolio, successful dividend investor who always brings a lot of humor to dividend investing. I will link to him in the pinned comment below. He is my homie. And so I want to move on now. I have some really cool insights to share with you all in the next segment. All right, everyone, as long as I'm in this beautiful setting, I wanted to share a few more insights with all of you today. One, I want to share what's going on behind me right now. People are commuting in their cars over the San Mateo Bridge. A lot of these people are commuting probably home from a long day of work. That's just always a friendly reminder. I actually run by here all the time. The reason I'm doing the video today is because when I was running, I was like, hey, this would be a great place to film a video. And one day I'll do that. That day has come. The reason I'm filming the video here is the purpose of dividend investing is that we all have options. We have dividend income that we can rely on that pays the bills so that we have options. If we want to commute, we want to go to a job like the folks commuting over the bridge right now, we have that option. But if we don't want to do that anymore, we don't want to commute, or we want to taper down the number of hours that we're spending in a car commuting to work, we have those options thanks to dividend stock investing. Something else I wanted to share today, I'm thinking a lot at a high level lately. Maybe it's because I'm getting older. I was watching the Too Short E40 rap battle, the Versus battle earlier this week with my wife. It was a lot of fun. And I just got to thinking, wow, these men are really successful. And one of the reasons they're so successful in the rap game is because their careers span many decades and their careers span many albums. And I wanted just to share that watching this today or this week, it brought back to me this notion that, hey, it takes time, everyone. It takes time. And it's a reminder to the dividend investors out there to keep the eye on the long game, keep the eye on the future, and realize that future may not materialize overnight, but as long as we enjoy what we're doing, we have purpose, we have a purpose-filled life. Dividends, in my opinion, create purpose. I discussed this in my last video. They can bring back purpose to a life that is otherwise in a difficult position. I love dividends for that reason, but as long as we can find that purpose in our lives and we can stick it out over the long term, that compounding, that snowball works miracles. And one way I just saw it this week was in E40 and Too Short's careers. And what was so interesting to see was how E40 was dancing in the rap battle. He still has it. He is so happy at what he's doing. And that's what's great too, is I love dividend investing. And that's one of the reasons I've been with it so long, and I'll continue to be with it so long. And I think it's so important, whether you're investing or whatever you're doing in life, to kind of find that long-term balance like E40 has, but also to think about how you can stay in the game for the long term and keep it fun. Something else I want to share while I'm here right now, sharing some high-level thoughts, is I consider myself kind of in this wedge generation. We're talking multi-generational today. I draw a lot of inspiration from the elders. A lot of those elders are in, I would call, the baby boom generation and older. Now, the baby boomers, quite frankly, inspired how I live my life. And when I was growing up, when you think about how do you live your life, there weren't all the options there are today. It was really trying to model your life after what the baby boomers did. Now, the problem with that is a lot of the circumstances that my generation had were different than the baby boomers. The price of housing, for example, was much higher. The price of anything was much higher. Getting into a company and getting to a high-level position, well, those were already taken by the baby boomers, and the baby boomers are working really long years. And so modeling our generation after what the baby boomers did, I think that got us to a certain point, but it is a flawed comparison. And that's when in my life, later in my life especially. I've been investing in dividends all my life just because I loved it, but it really clicked for me later in life when I realized, hey, my generation, my life, it can't just be modeled after what the baby boomers did. It's different. It's a different generation. And that's when I started realizing, oh my goodness, I can go about things differently. There are other options. I don't even have to work. I can craft a dividend portfolio that pays for my lifestyle. I can start hacking life, find ways to hack life. And so that's my generation. But I look towards the younger generation, like my kids, and it gives me so much hope, because a lot of the things that my generation, like this wedge generation, if you will, like it's wedged between the boomers and the younger folks, we kind of figured out later in life. I'm making darn sure that my kids figure this stuff out earlier in life. I'm making sure that they figure it out earlier so they can enjoy the benefits of all of the challenges, if you will, earlier in life. And one of these things is really having that flexibility to go about life on your own terms. I think this is something the pandemic has taught us, that this year people are working remotely. This year people are starting to really realize and wake up that geo arbitrage is possible. People are realizing, hey, I don't have to do things how they were always done before. Hey, I can make money online and work from the comfort of my home. And I can pursue my passions. I can live life on my terms. Just because I grew up this way doesn't mean I have to do that. And so for my kids, one of the things that's so important is I want to cultivate that introspective thought. I want them to realize they don't have to live life the way I lived life, or the way their mom, my wife, lives life. They don't have to live life the way the grandparents lived life. Their generation is different, and I want to empower them from the beginning that they don't just have to model themselves after what was done. And that's what gets me to just thinking about multi-generational. I like to stay humble, quite frankly, because I draw inspiration from the elders, from my generation, from myself, and from the kids out there, from the younger generations. And so my portfolio is a reflection of all of that, with a high bias on what works for me. But if you're young, what an awesome time to be a dividend investor. There's so much opportunity ahead because there's so many years. But if you're older as well, like me, I'm starting to be an old guy. I realized that when I was watching E42 Short this week, and I was just, man, I loved it. I was eating it up. But I was like, wow, these are tracks that were from the 80s and 90s. I'm dating myself. I'm getting older here. But even if you're older like me, there's still so much hope. There's so much hope because we're all living longer. There's so much change that we can all be inspired by. And there's so much opportunity now in this world that was not opportunity before, because people are starting to realize you don't just have to do things cookie cutter. You can live life on your own terms. And so just wanted to share a few of those fun thoughts today for the new year. I love you all. All right, everyone. I'm getting tired. Before we leave today, in terms of full disclosure, I am long most of the stocks mentioned today. I own Johnson & Johnson, ticker symbol J&J. I am long Apple, ticker symbol AAPL. I am long Clorox, ticker symbol CLX. I am long Starbucks, ticker symbol SBUX. I am long McDonald's, ticker symbol MCD. I am long Southern Company, ticker symbol SO. I am long Duke Energy, ticker symbol DUK. I am long Walmart, ticker symbol WMT. I am long the Home Depot, ticker symbol HD. I am also long 3M, ticker symbol MMM. I am now long, as of today, Utz Brands, ticker symbol UTZ. I am also long PepsiCo, ticker symbol PEP. I am also long Campbell Soup, ticker symbol CPB. I am, actually my kids are long the Hershey Company, ticker symbol HSY. That is their holiday Christmas gift this year. I'm so excited. Also, I am long Bitcoin, ticker symbol BTC. I own all of those stocks and assets in my personal dividend stock portfolio, and my kids own Hershey's. Also, in terms of a friendly disclaimer, today's video is not investment advice. I am not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. Losing money in the stock market is a very real thing and very possible, especially with the extreme volatility we have seen in recent years. And the portfolio that I am sharing today, the hypothetical portfolio, is very aggressive on a risk profile as compared to most of the portfolios, sample portfolios, hypothetical portfolios that I have shared here before. So special attention to keep that in mind today.
I love you all. Before we leave today, please include a comment below, subscribe, hit the like button, smash that like button, destroy that like button. It means the world to me. Check me out on Patreon if you want even more bonus content over there. Merry Christmas, Happy Holidays, Happy New Year, Happy Hanukkah, Happy Kwanzaa. Love you all. I will see you in the next video.